The S&P, the Nasdaq, the Russell, the Dow Jones, they all fell since the beginning of 2022. The S&P lost around 13-14% since the beginning of the year, and because of that, there are a lot of opportunities that you can take if you're willing to trade options. And one very cool strategy that you could use if you're willing to take advantage of the S&P right now is called the credit spread. So we're going to talk about credit spreads. I'm guessing that you must have heard about credit spreads before if you're interested in options. We're going to see why credit spreads can be such an attractive strategy, especially in this type of environment, and I'm going to give my opinion on what I think about this strategy, how I would use that strategy right now on the SPY. So hopefully if you're willing to do it yourself, maybe it gives you some guidelines or some directions on how to use credit spreads. So as I said before, the SPY fell around 14% year to date. And as we can see on this chart, so this is the chart for the SPY, and the SPY is the ETF for the S&P 500. So essentially it's the same thing, like the SPY, the S&P 500 is basically the same thing. We can see that on the chart of the SPY, it's quite crazy what we have been going through since the beginning of 2022. I mean, don't get me wrong. This is not the worst down move that we've seen, like over the last 50 years. We have seen a lot worse. But since the crash of 2020, since that moment where the stock market lost around 35% in the span of 6 weeks, it was back in 2020, we haven't had a down move lasting that long for quite a while. And that's quite interesting because myself and I think a lot of people, we weren't expecting, for example, such a move and also a constant down move on the S&P 500. We can see that it went down at first, then came back around 456, and then after it came down, came back up again, and now it's down again, and we're wondering if we're not going to go lower. And personally, when we came back around 457, I'm gonna be full and honest here, I definitely thought that that was the end of that down move, and that was just going to be a bad memory, and we were going to continue going up. And that's why it can be interesting, to trade options in this type of moment, because even if you're, let's say, a bit wrong, then you can manage to get yourself out of a bad situation trading options. And because the market is down now, it can be a good opportunity to trade credit spreads. And hence why I wanted to talk about credit spreads in this video. So first of all, what are credit spreads? Credit spreads consist in selling an option and buying an option at the same time. So you'd probably ask me, why would I bother selling an option and buying an option at the same time? Is there any use to that? Well, there are quite a lot of good things about credit spreads. The reason why you would like, for example, to trade credit spreads, meaning selling an option and buying an option at the same time, either it's calls, either it's puts, there are several reasons why you would want to trade credit spreads. The first one is that it's going to limit the capital that you need if you're willing to trade, for example, the SPY in this example. For example, I just simulated a trade where if I was selling, for example, the 385 puts on the SPY, I would need to have in my account for that trade, just that trade, $5,595. And remember that, you cannot go all in for just one trade. So that money, $5,600, should only represent a tiny portion of your capital so you don't put yourself in too much danger. So you can see that if you're selling a naked put, if you're just selling a put on the SPY, it can represent quite a lot of money if you're willing to trade the SPY. And that's why credit spreads can come quite handy, because you don't need as much money to trade the stock compared to if you were selling, for example, a naked put like I just showed right now. For example, if I was, let's say now, turning my naked put into a credit spread. So I'm going, as I said before, I'm going to buy another option at the same time as I'm selling one. So in our case, let's say that I'm selling the 385 puts. As you can see here, it's red, meaning that I'm selling it. And then I'm buying the 383 put. You can see it's green. It means that I'm buying it. So you see that I'm selling an option and I'm buying an option at the same time. And that's a credit spread. That's actually a put credit spread, because I'm selling a put and buying a put at the same time. And when you sell a put credit spread, you're bullish, meaning that you want the stock to go up. And then if you want to be bearish, if you want the stock to go down, well, in that case, you can sell what we call a call credit spread. So in that case, you would sell an hard money call, for example, let's say the 416 call, and then you can buy another call at a higher strike. So let's say the 420 call. So you see that you're selling a call and buying a call at the same time. And by doing this, you are bearish. But as I said, you're using less capital when you're trading credit spreads. For example, let's say that I sell the 385 puts and I buy at a lower strike the 380 puts, meaning that I am bullish because I'm selling a put credit spread, and by doing that trade I would only need $396 to open the trade, and I can potentially make $104, and my max loss could be what I'm investing in that case, the buying power required, which is $396. So you see that now it's completely different compared to when I was looking at selling a naked put. And honestly, you know, I started with credit spreads when I started out with options. I didn't have like, you know, tons of capital, so I was always going for credit spreads because I just didn't have the money to, you know, sell puts on plenty of different stocks. I mean, I couldn't sell naked puts. It was requiring way too much capital compared to what I had. Hence why, you know, credit spreads can be quite interesting, because if you have a smaller capital and you still want to trade the stock, then it can be interesting to just, you know, go for put credit spreads if you're bullish, for example, so you can still trade the stock and not require as much capital to open a trade, like in the case of a naked put. After that, you can always change, for example, the strikes that you want. You need to understand the width of the strike. So the width of the strike is the difference between the strike that you're selling and the strike that you're buying. So in our case, for example, you see that I'm selling the 385 put and then I'm buying the 382 put. So you can see that the width of the strikes between those two strikes are 3, because I'm selling the 385 and I'm buying the 382. And a quick way, if you want to know how much you can risk on a trade or how quickly you can judge if that trade is good for you, your max loss is the width of the strike minus the credit that you're receiving. So in our case, you're, for example, having a width of the strike of $3 because I'm selling the 385, I'm buying the 382, so the difference between the two is $3 of width of the strike. And then you can see the credit that I'm receiving is of 65 cents. So if we want to calculate the max loss quite quickly, you take the width of the strike, $3 minus 65 cents, and that is going to give you a max loss of $2.35 if I know how to count. Yes, indeed. You can see the max loss is of $235. So you see, just before I said $2.35 because in one option there is 100 shares. So you need to multiply the number by 100 so as to have the real max loss. So $2.35 of max loss is actually $235. So that's the first reason why I honestly love credit spreads. Is I used to trade credit spreads a lot, now I trade them less, and the reason is because I have more capital at my disposal, so I can actually trade more naked puts instead of selling credit spreads. Another big advantage of using credit spreads is that you take advantage of what we call high implied volatility. So, you know, if you don't know what it is, like, we're going to do it quite simply. You don't need to go into too many details about this. You're going to see that it makes a lot of sense. So I just mentioned implied volatility, so let's call it IV for the sake of this video, otherwise I'm going to repeat it all the time. So basically the IV, the implied volatility, represents the expected move of a stock. The higher the implied volatility, the more we expect from a stock in terms of movement, and vice versa. The lower the implied volatility, the smaller the move that we expect from the stock. And you can essentially put it in a chart like this. So if we look, for example, at this can be, you know, the implied volatility for whatever stock that we're talking about. It doesn't matter, it's always the same thing. Each stock has an implied volatility, and actually, you know, it goes even deeper than this, but no need to talk about it. So let's say that you have the implied volatility of a stock that is doing this. So you can see that at the beginning, it's actually quite low, then it goes up, then it goes down again, then it goes up, etc., and then it finally goes up. The thing with the implied volatility is that it's also like a thermometer in a way to judge how expensive or how cheap option prices are right now. So the higher the implied volatility, the more expensive the options, and the lower it is, the cheaper the options. So it's actually quite handy because it gives you a quick way of knowing how actually expensive or cheap the options are. Because if you look at the chart of the implied volatility, and based on what we just said right now, the higher the IV, the more expensive the options, then it means that at that point, as we can see, as the implied volatility is the highest for that particular stock, well, that means that the option prices are at their most expensive. And yes, that's exactly that. And vice versa, if we look at the lowest point, which is, I think, maybe here on this line. So at this point, which is the lowest point, we can say that the IV is at its lowest, and so the options prices are at their cheapest. So why do we care about this? Why do we care about the implied volatility? And okay, that's cool that we know that it's like a thermometer to judge how expensive or how cheap options are, but why do we care? Well, we care because when markets go down, and especially, you know, during crashes, I mean, any down move that happens quite quickly is going to make the implied volatility of a stock go up very quickly too. And that is going to have as an effect to see the option prices, they're going to get more and more expensive as the stock that you're looking at is going down. And in the case of the S&P 500, we can see its implied volatility by looking at actually a product that is called the VIX. So you must have heard about the fear index. That's something that we usually see on internet, like they call this the fear index. They talk about the VIX actually. And we can just quickly jump into the VIX by typing VIX in the search bar. And then you can see that basically looks like this. So it's not like a normal stock. You know, the VIX is not a normal stock. It's the implied volatility of the S&P 500, and they actually made a product out of it. You can trade options on the VIX. I mean, it's another way of making money basically. But you can see that it's not a normal stock, and that's what we call a volatility product, meaning that it's not, you know, a company. It's actually just the implied volatility for the S&P 500. That's why you can see that it's moving in such a weird way. I mean, you can see it's going up very quickly, and then it's going down actually more slowly. And this is the crash of 2020. I mean, you know, that's crazy. And the VIX is measured actually in percentage. So if, for example, here on March 18th, we were at 83, meaning that we were expecting an 83% move on the S&P 500 either up or down. That's what it means when you see the VIX at different levels. If it's at 20, then we expect a 20% move on the S&P 500. And, you know, you can guess that's for every number like this. And that's for every stock. Every stock has implied volatility, etc., etc. So why do I talk about this? Well, I said that, you know, just 2 minutes ago, that if the implied volatility of a stock is really high compared to what it was before, then we can say that the option prices are also getting quite expensive. Meaning that if, for example, let's say that you're willing to buy options, then it makes sense to buy options when the implied volatility is very low. So if you buy options, they're actually very cheap. Because if we look at the VIX right now, we can see that the VIX is at 30, which is relatively high compared to where it was. So we can say that based on the implied volatility of the S&P 500, which is the VIX, we can say that options are pretty expensive right now because the VIX is higher than usual. So if you're willing to buy an option, then it's maybe not the good time to buy an option on the S&P 500 right now, because options are a bit overpriced right now because there's a lot of fear in the markets. But it's actually a good time to short options. And when you're selling credit spreads, you're overall selling options. You're going to sell an option and you receive a credit, and you're going to buy an option at a cheaper price. So the difference, you're still short overall. That's why it's quite interesting to trade credit spreads, because you're short volatility. And by having the implied volatility going down, so let's say that if we were looking at this chart and the implied volatility suddenly goes down and you had shorted options at the, you know, highest point the IV could be at, well, you're going to make money almost instantly, because as the IV is going down, option prices are getting super cheap all of a sudden without necessarily having the stock to move or whatever. So you're making money by shorting that volatility. And so now you can see that your profit do not only depend on where the stock is going, it also depends on, for example, where the volatility is at, because it's going to dictate how expensive or how cheap the options are. For example, if we look at where the VIX is right now, you can see it. When you trade a bit, you will get used to the prices, to the option prices, and you will see by yourself that when we are in a high implied volatility environment like we are right now with the VIX at 30, you can see that overall across the board, options tend to be more expensive. You will see it yourself. And if we are at, for example, the VIX is at 15, you will notice yourself that options are cheaper than what they usually are. Because if you used to buy options that are like $1, $1, and then the VIX falls, like, let's say to 15, now you're going to see that they're going to be at like 70 cents, 60 cents. You're going to see that they are much cheaper than usual. That's because the implied volatility went down. So I hope it makes sense what I'm saying. I'm trying to make it as simple as possible, but it's not an easy subject. But the reason why I was saying that credit spreads can be useful right now is, as the implied volatility is quite high here in this environment, as I said, the VIX is at 30, then we can take advantage advantage of that IV by selling a call credit spread or a put credit spread, depending if you're bullish or bearish on the S&P 500. So not only you can make money, for example, by if you're right on the stock, but you know that options right now, they are very expensive compared to what they're usually worth. So even if, let's say, you're a bit wrong on the stock, you might still be right on the direction of the volatility, because we know that usually this type of volatility is not sustained over time. Usually it goes down, it comes back to a mean. As we can see on the VIX, you can see that it tends to go up very quickly and then it goes down always back to a certain mean. And that's what we can expect of the implied volatility in general. We can expect it to pop up like very quickly and then go down quite slowly. And another reason why, you might want to use credit spreads is that when you're selling options, you're essentially earning money on a daily basis thanks to the time decay. So for those who don't know what the time decay, very quickly, the time decay is basically every options, every single day, they lose a tiny bit of value. They're going to lose a tiny bit. It's not a lot, but the closer we get to expiration, the bigger that amount. So to show you maybe in a more visual way what the time decay is, if we're putting it in the graph, so on the vertical axis, you have the value of the option. So let's say that it's how much extrinsic value there is left in the option. And then on the horizontal scale, it's the time. So if we had to picture, for example, how the time decay looks like, let's say that here it's like 0 days to expiration. Here it's like, let's say 50 days to expiration. And at the beginning, let's say that it's 100. So how the time decay works is that every day, as I said, the options are going to lose a tiny bit of value. And then as we get closer and closer and closer to the day to expiration, we're going to see actually the time decay accelerating. The options are going to lose more and more value as we get closer to expiration. At first, you're going to lose, maybe when you're at 100 days to expiration, you're going to lose like, let's say 20 cents a day. And then when you are like in the last month of expiration, you're going to see that it accelerates. You make more and more every day when you're shorting options, and you're going to make like, let's say $1 maybe a day, $2 a day, whatever. So that's quite cool, because when you sell options, you can take advantage of that. After that, there are some more complicated things. For example, if you sell an option that is further at the money, then that time decay is going to reduce. But overall, when you sell options, you're going to earn money from the time decay, depending if it's further at the money or in the money or at the money, whatever, is going to be more or less time decay that you earn. But across the board, when you sell options, you're making money through the time decay, which is quite cool. So that's another reason in favor of selling credit spreads, is that not only it doesn't need a lot of capital to actually trade credit spreads, but also you can take advantage of that high implied volatility. And on top of that, you can make money by just having the time passing thanks to the time decay. So that's pretty cool. So now that I've talked a lot, like a lot of theory, a lot of boring stuff, how do you practically trade credit spreads on the SPY? So I want to show real examples to see how you could do it if you're bullish or if you're bearish. So first of all, let's cover if you're bullish, meaning that you're going to sell a put credit spreads, because when you sell put credit spreads, you want the stock to go up. You're bullish. So the first thing to choose to talk about if you're bullish and you want to trade credit spreads on the SPY is which expiration should you choose? Because you can see that when I type the SPY in TestyWorks, my broker, you arrive on this page where all the different expirations. So which one should you choose? Should you go for closer expiration, as I said, that you make more from the time decay? Or should you go maybe for longer expiration, so you have more time, but you make less money from the time decay? What should you choose? Well, there are different, school of thoughts, let's say, like when it comes to choosing expirations in the world of options. There's, for example, the Testy Trade way, where they say that you should go for like 50, 45 days to expiration, because that's where from there where you're going to make the most money from the time decay. So going, for example, for the expirations around the 50 days to expiration is optimal according to them. But there is also another school of thought where you want to go to the closest expiration possible so you can make the most money from the time decay. So what is the good answer between the two? Well, honestly, there is no good answer. I mean, that's not how it works, unfortunately. Otherwise, everyone would do it. There is only what you prefer, and here's why. If you go for an expiration that is closer, let's say you go for the May 13th expiration or the May 20th expiration, which is like 13 days to expiration. Yes, you're going to make more money from the time decay. but there is something that we call gamma. So if you go closer to expiration, you can expect a bigger gamma, and what that means is that you're going to have bigger volatility in your P&L. Let's call it like this. If you're willing to go closer to the expiration, like for example the May 20th days, 13 days to expiration, let's say that you can expect to have like more moves in your P&L, it's going to be more volatile. But you know, if that's what you want and if you don't mind it, then maybe that's right for you. But maybe if you want to have less volatility in your P&L, you want to have, you know, maybe, I wouldn't say more predictable because that's not like really how it works. But let's say that you want to have less volatility in your P&L, then maybe going for a longer dated expiration is better for you, like 50 days to expiration, 45 days to expiration, more the tasty trade way. Personally, what I tend to go for is I tend to go for longer dated expiration. I don't necessarily like having a lot of volatility in my P&L. That's why for me, it fits me better to go for longer dated expiration. Let's call it 30 days, 40 days to expiration. So let's say that I go for the June 17th expiration, as it's 41 days to expiration. So it matches a bit what I said before when trying to find an expiration that is like around 40 days. Now, when you open the expiration, you're going to find yourself in front of the option chain. So on one side, you have all the calls. On the other side, you have all the puts. That's basically how it works for most of the option platform. If it looks intimidating, don't worry. I mean, honestly, you need to look at it once or twice and place 1 or 2 trades. And then, you know, you get used to it very, very quickly. So first of all, if you're bullish and you're willing, for example, let's say to sell then a put credit spreads, because when you're bullish, you sell put credit spreads, I definitely recommend, in my opinion, to go for at the money strikes. So let's say that you go for at the money strikes, and one very good way to judge how far out the money you are is to look at the delta. So you can see that there's this column delta, and that's usually a quick way of knowing where you are in terms of out the money or how close out the money you are. You can look at the delta. Personally, I tend to sell on all the stocks the 25 delta. That's usually where I fall when I sell an option. So that would mean that, for example, you sell the 385 puts. But as I said before, if you only do this, that's a naked put, and we don't want that. We want to sell a put credit spread. So we're going to have to buy an option at a lower strike. So let's say that you, for example, choose the 380 put. In that case, the width of the strike, as we talked about before, is of $5, and I'm collecting in total $1.04 of credit. You can see that I initially sold $7.20 of credit. That's why I collected when I sold the option at 385. But then by buying an option at the 380 strike, I'm paying $6.20. And so the difference between the two is of $1.04. So overall, I'm selling a credit spread, a put credit spread, collecting $1.04 of credit, which makes me short volatility, as I explained before. And by placing that trade, I will only need to put $400 on the table. My max profit would be $104, and then my max loss would be $396. So you see that, you know, it's completely different compared to before, when you needed to put $5 grand on the table to just place a trade. And you can adjust after that. You can adjust like how much you want to risk. If you bring your long leg, when I say long leg, I mean the long option that I'm buying. And then when I say short leg, is the short option that I'm selling. If you bring your long leg closer to the short leg, you will have a smaller max loss because the width of the strike will be smaller, but you also make a smaller profit. You know, there is no magic trick here. I mean, if you want to risk less, then you're going to make less. If you want to risk more, then you're going to make more. That's usually how it works for everything. There is no tips, or there is no trick, or there is no gimmick here. It's really just how it is. But is there a rule of thumb that you can use maybe so as to know which strikes to choose? Maybe they can be helpful. Well, let's call it that way. There is no like rule of thumb that is going to dictate how to place your strikes all the time. But let's say that if you can stick in terms of risk to 2% of your capital that you risk per trade, or 3%, let's call it like this, I think that's a fair trade. I mean, that's not a too risky trade, and at the same time you take enough risk so it makes it actually worth it. So let's say that, you know, for example, you're willing to sell the 385 puts on the SPY and you're willing to buy the 380, so you're selling a put credit spread with the $5 width, the max loss would be $396. That $396 should only represent like 2% of your overall capital, of the cash that is in your account. That's your net liquidity. That's what I respect myself, around 2% per trade, even less, actually 1.5%. And you know, honestly, it goes well for me. That's, I think, what is an optimal risk per trade, because you never know what can happen on a stock. I mean, you know, as much as right now the S&P 500 lost 13%, who knows, maybe in the next 6 months is going to lose another 20%. So, you know, you want to take risk, but you don't want to take unnecessary risk, because you never know what can happen. I don't know, you don't know it, no one knows it, honestly. So that's how you would do if you are bullish. But now let's look if you are bearish and you want to sell a call credit spread because you think that the S&P 500 is going to go even lower. In that case, we do the same thing, but on the opposite side. We're going to look at the call side. So let's say that we go, for example, for the 430 strike. By selling it, we're collecting $5.43. You'd see that if you were just selling that naked call, you would need to put on the table $6,364 worth of buying power just to open the trade. So you can see that honestly this is expensive, because this, if we respect the rule that I just said before, the 2% risk per trade rule, then that means that you're going to need to have a lot of capital to be able to trade a naked call on the SPY. That's why honestly credit spreads can be so handy, because it allows everyone to at least participate based on the capital. So for example, let's say that we buy the 435 put after that, so as to make a call credit spread. So you see that you sell a call at the 430 strike, and then you're buying another call at a higher strike at 435. Your max profit on that trade is of $154, and your max loss is of $346. You see that it's much more affordable than selling a naked call by itself. So when we look at the S&P 500 chart right now, what do I think? What would I do if I was willing to trade credit spreads on the SPY? Well, personally, I have a bias, you know, that tends to go toward the put side. I tend to sell more puts than what I sell calls, meaning that I tend to be more bullish than we are bearish. The reason why is that when we talk about indexes, for example, like the S&P 500, yes, of course, you know, you don't want to catch a falling knife. So if you're bullish and you buy, for example, the S&P 500, or you sell a put, if for example, the S&P falls lower, even lower in the next 6 months, then yes, I'm going to be in a loss. However, I always think, you know, of the stock market like, you know, a store, and then it gets on discount when, for example, prices get lower, like right now, like by 15%. For me, it's another buying opportunity when it comes to the stock market. I don't necessarily like to be too bearish, because I think that the stock market tends to go up on the long term, so I want to be on that side. But I'm biased here. I tend to, you know, sell way more puts than what I sell calls, and it can work very well in years like 2021, and it can work, you know, a bit less in years like 2022. So if I was willing to trade credit spreads on the SPY, I would go for a put credit spread. So I would, for example, sell, let's call it the 390 puts, and I would probably be buying the 380 put, which makes a max profit of $226 on the trade and a max loss of potentially $774. That's probably what I would go for. But know one thing, when you trade credit spreads, that's really the bad side of it. It's going to get really hard to manage your trade by rolling it to another expiration, for example, if it goes against you. Compared to when you're selling naked puts or naked calls, like when I showed you at the beginning of the video, where it's like super expensive to sell a naked put, it's a lot easier to manage a losing trade when you're only selling a naked put. Because you're buying that long option when in the credit spread, meaning that when you're buying, for example, the put when you're selling a put credit spread, or when you're buying the call when you're selling a call credit spread, because you're buying that option in the trade, it makes it a lot harder to defend your trade if it goes against you. So maybe, you know, if you're considering trading credit spreads on the SPY, think of it as either it works or either it doesn't. There's not going to be a way to defend too much your trade compared to if you were selling a naked put. So maybe if you're willing to trade credit spreads, don't risk too much, because you know that if you're, you know, selling a credit spread, well, it's a hit or miss. Either it's going to work or it's not going to work, but you pretty much cannot do much if it goes against you. Just know that. I hope that video was interesting. I tried to show, you know, a bit of a guide, like let's say for credit spreads. That's honestly a strategy that I tend to use a lot, especially I tend to use it in low volatility environments, and that's also what I started with. I mean, I think it's a great beginner strategy because you don't need a lot of capital, as I said. You can take advantage of the time decay, and you can take advantage of high implied volatility like we are in right now. So that's why it makes it quite a suitable strategy for this environment at least. If you have any questions, don't hesitate to comment it down below. I'll be happy to answer any question that you might have, or just, you know, chat with you if you want to. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.